Get off the sidelines and take control of your financial future at www.tackletrading.com. Get in the game.
Well, great. Moving averages can be a pretty big topic, and there's lots and lots of different viewpoints on moving averages out there. In fact, there's lots of different kinds of moving averages. The most common moving averages are that 50, 20, 200 moving average. What are some of your favorite moving averages? Go ahead and type into the chat what number, if you've got a special number moving average. I see a 9. That sounds like Mark's influence all over the place. A 50, a 20, an 8, and a 13. That sounds like a Donna Miller influence. A 200 hourly. There you go. Yeah, I mean, there's tons of them. Now, how many of you have used exponential moving averages versus simple moving averages, or compared triangulated moving averages, or any, there's all kinds of different ways to approach it. Okay. Well, what if I went completely sacrilegious on you for a moment and told you that at one point in time, I abandoned all moving averages and decided I didn't like them because they lagged behind. Why not? But hey, moving averages are, you can look at them, and I think they bring a tremendous value. One of the questions I asked myself was, well, why 20 days? Why 50 days? Why 200 days? And these moving averages have been around for a long time. And it really, the 20, 50, and 200 literally dates back to, there's 21 trading days in a month, and early technicians didn't even have pocket calculators, so they rounded it off to 20. There's 63 trading days in a quarter, and without a pocket calculator, it was easier to calculate 50 days than it was to calculate 63 days. So they did the math again by hand. And then the 200, there's 252 trading days in a year, and they rounded it off to 200. So the 20, 50, and 200 come from early technicians being lazy at math and rounding it off. And those institutions have used those numbers and since then. But to be quite fair, do you think Goldman Sachs's trading algorithm really relies on 20, 50, and 200s? Or do you think they've gone way above and beyond that and hired an entire team of quants that they keep chained into a room where they feed them pizza and make them, try to solve for the equation on chaos theory? They do a lot of different things to give them an edge. Now, I think the 20, 50, and 200 are common enough that they have a lot of value, a ton of value. And the fact that they talk about like the 200 period moving average, Flash Boys at work, Ben, exactly what I'm talking about. But if they're talking about the 200 period moving average on CNBC and on Bloomberg, and the news headlines come out that the market bounced up off the 200 period moving average, does it have relevance? No, absolutely. Okay. So I find that if you focus on the moving averages, you that's something that you can take a lot of value from, and they just become simple reference points and decisions. So we're looking at the S&P, and again, that 200 period moving average, I think is a big one that, put it on your chart. Keep a chart with moving averages, keep a chart without moving averages. And it is entirely possible to put too many moving averages on the chart. I used to use a rainbow moving average indicator that had I kid you not, had 15 different moving averages on it. And it just looked like a really cool rainbow. It made my charts pretty, but I don't know that it really helped me make better decisions. How many of you use moving averages as trigger points, like buy above a moving average, sell below a moving average? Okay. And that can be very, very valid. In this case, I think we've got a very interesting scenario. You got the 200 period moving average. You also have the big fat number 2600. You've got old support resistance zones that coincide with that. And so, you kind of look back here and you see resistance at 2600. You can see where the bodies in the open and the close are around 2600. But then you also see those shadows down here at the 200 period moving average. So a fat number, a moving average, a previous support resistance zone, that's a lot of support. So if it breaks down below that moving average, I have no problem deciding to sell, because that's a big, big, big threshold. At what point would you consider it a time to buy? Like stepping off a crowded city curve, if the masses, you can do it if the masses do it. I think that's a really good way of looking at it, is if the masses are looking at these as points of making decisions. Oh, you could throw a fib on there, and that would certainly take us off topic. But, for a while, I preferred my Fibonacci's to my moving averages. And then, I preferred, oscillating indicators to give me buy and sell signals. These days, I keep my charts relatively naked. I actually had to go add moving averages to my chart just so we could talk about them. But there's just a lot of points of reference there. And again, the idea of a violation or a confirmation above or below a moving average, I think one of the best things about it is it just gives you a very simple method for decision making. And it's the humming and hawing that I think gets people in trouble, is the indecision. So, that general idea. So buy above the last three candles. I mean, that certainly can be a good signal. Again, what matters is that you have a signal and a decision-making process. How many of you are still trying to figure out what your decision-making process is for entry and exit points? Okay, yeah, and that's really, really common when you're new to trading. Okay, how many of you have had lots of different information given to you on types of entry and exit points? Some people say the 8, some people say the 9, some people, I actually listened to two guys argue over, which was better, simple moving averages or exponential moving averages, like it was, which is better, Bud or Bud Light, less filling, tastes great. The argument was not going to resolve itself because they both had their their confirmational bias. They had their pre-decided opinion, and they weren't going to convince each other. So moving averages, again, are a pretty phenomenal tool. The most common uses is moving averages are catalysts for support and resistance, where you'll see prices, where moving average will come down and stock prices will hit a moving average like you see over here. And you'll see prices bounce up or bounce down off the moving averages. The other thing that people look for is the violation, like you see prices cross down below the moving averages.